know we're about 30 minutes late and we're eating into your lunch, so we'll try and keep this exciting and fact-revealing, at least for the next 30 minutes. We'll leave 5 to 15 minutes for Q&A, depending on how enthusiastic based on what we're talking.
Yeah, good afternoon, everyone. And like Vish said, don't want to stand between you and the lunch. First of all, I must say this, I'm extremely happy to be here. Originally a Malayali, born and brought up in Kerala. And in fact, this is the first time coming back to Kerala and doing an event like this. So very, very happy to be here. I can speak Malayalam, but I think it's more appropriate to speak in English now. What Vish and I are going to try and do is, long way back, we worked together on my last venture where Vish was the investor and I was the entrepreneur, though we dressed differently now. But we're going to sort of try and share the experience that we had. So Venture East and Vish, in fact, as a person, invested into Loyalty Rewards, my last venture on day zero or pre-day zero, and went through the whole Series A, Series B, Series C. And eventually investors exited, and eventually I myself exited post an acquisition of the company. It's an interesting journey that we had, and our intent is to try and share with you more for the entrepreneurs who are here, and Vish will of course share the investor perspective of the journey. That's really what we're trying to do. So brief background perhaps. So I met Vish when both Vish and I were young and I had hair, very, very early days. I had passed out of a business school and went and worked in the corporate world for a few years. I used to manage the loyalty program for an airline called Jet Airways, wonderful airline that unfortunately is not there now. And then I worked with MasterCard worldwide. While working with MasterCard, I wanted to start up, but I didn't have any money and I didn't know this whole venture capital. I didn't know people were willing to give me money to start. I was pleasantly surprised to know that. And I went and met Vish, which is when Venture stepped in and wanted to fund. And Vish was, again, very, very young at that point of time.
Yeah, I was a rookie investor, possibly my first deal, yeah.
Yeah, so first deal for Vish, pre-day zero investment for me. I think that doesn't happen in India very often. I was still working in MasterCard day job, and weekend job was fundraising, where I went and met pretty much every VC who could give me half an hour and would pitch my story. And I hadn't even quit my corporate job. And strangely enough, one of them actually wrote a check, and they eventually ended up investing $3 million into the company. So it was not, we skipped the friends and family, angel, went straight to Series A, pre-zero. I got the term sheet, and then I went to my boss and resigned. So that doesn't happen very often in India.
Yeah, but these days they give term sheets to people who are in college. But anyway, that's it. That's a different story. But just to sort of step back now that the slides are up, this is a special journey because this is a rare situation where there's a founder and there's an investor, and both of us sort of have very little experience when we got started on our journey. So there's a lot of shared learning and a lot of respect. A founder himself has gone through Series A, B, C, scaled a business, built a profitable business, gave an exit to the investors and himself. And I'll store some more news towards the fag end of it. So it's a very interesting journey. It's a happy journey. Of course, there are lots of ups and downs. The ending seems happy at this point of time. But I think that's what we're going to sort of try and walk you through our learnings, what's worked, what didn't work, what are things that you need to reflect upon if any of you are going to go do a startup or raise money or already having raised money.
Yeah, this is an important point, and often enough we hear about, given the way venture capital investment and startup ecosystem is developing, there's only one disclaimer that we really want to put, and that is that there is no silver bullet. There is no secret recipe or there is no secret sauce. At least for Vish and I, our 10-year journey of building an organization, exiting, it's an everyday walk the talk, everyday highs and lows. There is no shortcut, and that's the only disclaimer that we would like to share with young entrepreneurs who want to go on to build a business. It's really about a lot of execution, perseverance, digging your heel deeper and deeper, and getting it through the line. And there's no shortcut.
Yeah, so quick background at my end, Bijai has already introduced himself. I spent some time in corporate, ran a startup, and then got a job in a venture capital firm, not knowing what venture capital was. This was 13 years ago. And after 13 years, I spent 10 years at a fund called Venture East, managed about $100 million. Bijai was one of our first partnerships, an enjoyable journey. At the end of 10 years, I reflected upon wanting to build an institution, be an entrepreneur myself. So I decided to be stupid, and I've set up a venture capital fund that does deep tech investments. So that's my entrepreneurial journey.
Yeah, in fact, Vish and I, even though Loyalty Rewards is behind us, and Vish is now an entrepreneur running his own fund, and like Vish said, foolish enough, by the time Loyalty Rewards came to the end of it, I had started to forget the early hard days, and I thought I wanted to do the second venture now. So we started another venture, and both of us, run our separate ventures, but continue to work very closely with each other. That's briefly our backgrounds.
He doesn't need me, he's just being nice. So this was an interesting sequence of events because we had at the firm a certain background, a certain thesis for what we wanted to do. And I'll sort of state that and I'll leave it there and I'll let Bijai talk about where he came from, his perspective and how we met and how this whole relationship started off, right? At the firm, without disclosing too many names, we had an investment in a company that was in the gifting business that essentially built a large supply chain inventory and a platform that will allow for people to buy gifts, whether you're a business or you're an individual. And one of the big extensions of gifting was to say, can we build this whole gifting folks into other verticals? And one of the verticals we were looking at that point, 12, 15 years ago, was a loyalty vertical, where we said if someone has loyalty points, then they'll want to buy a gift, and then our platform can sort of be the back end for the gifts. So this was sort of one of the theses that we were playing within that company for a growth model. And we were quite keen to see if we could find a way to sort of upward integrate our business into this vertical and see if our own business can grow. And that was sort of the thesis with which we were sort of walking around and talking to different people who were trying to do consumer loyalty back then.
Yeah, for me, like I said, I hadn't really started up, besides the fact that I worked in Jet Airways managing their loyalty program. I felt that there's more work to be done in India in the loyalty space. And I had a business plan, but I didn't have a company. I didn't know how to start a company. So for me, it was miraculous that there's a venture capital fund which came forward and gave me a term sheet, which is the first term sheet I ever saw in my life. And kicked about it, and then went back and quit my job and started up. So from my perspective, it was an opportunity that the ecosystem really provided, and I think all that I could bring to the table at that point of time was wanting to solve a problem or a passion to do this, and some decent understanding of the industry. And yeah, with that on pre day zero term sheet, I really hadn't even quit when the first term sheet came. So that was that. And then why startup? That's something which, a very relevant question in some way for a lot of youngsters. The only thing that I can share is, as an entrepreneur, I've often heard people saying that, oh, I don't want to have a boss. I'm quit having a boss. I want to be my own boss, or I want to create an organization. And in my case, I always had fabulous bosses. I was very, very happy with in fact, when I quit my last job and started up, I got my boss to be on my board. So continued to carry the boss forward. So I really liked the whole idea was burning desire or passion to do that business. I felt that there's stuff to be done in that space. And I worked in the loyalty industry before in India. And so that's the only reason for you to start up. And it's really not a plan B where when other things are not working for you, that's when you go and start. I think when everything is working for you and you're on top of your corporate career, when things are going extremely well, is probably the best time for you to go and start up. That's my take.
Yeah, and I think to sort of chime in a little bit and to sort of bring in some parallel relevancy. We run a fund, we made about 12 investments. The entrepreneur's age goes anywhere from 25 to about 45, 50, right? And I think we're increasingly coming to understand that there are different businesses that are working on different technologies. And the way technologies are evolving, sometimes we're working on technologies that don't have history. And if things don't have history, then it's hard for you to look for a vintage and experience in the entrepreneur. But what is important to look for is there a strong motivation, strong desire to sort of build a large outcome or sort of create a dent or create an impact, right? And I think that's sort of important, and it's not going to be a glorious journey. It's a lot of hard work. I mean, when someone runs a company for 10 years, they're essentially giving 15, 20 years of their life in that 10-year period. And I think people just need to be cognizant and fully convinced before they get in, because sometimes it just could be fashionable to do a startup, but it's just a lot more pain than glory.
Yeah, and like the last line, one of the things that I feel strongly seeing what we see in today's startup ecosystem is startup is really, really not for everyone. While there are a lot of youngsters who want to start up and it dream in the eye, the associated glory of being a founder, all of that is, but startup's actually a very, very hard thing. All the glory and all of that from the outside. The inside life of an entrepreneur is extremely tough, and it's really not for everyone. And each individual will really need, I'm not saying this to discourage anyone, but the honest truth is that it's a very hard thing, and people should really understand what it takes before jumping in, because it's a very hard path to walk. But also, if you're a true blue entrepreneur and you have that running in your blood, there is nothing better than that. It's every day is a high. While there are highs and lows, but every day is a high. Every challenge is also a high. But it's hard, and it's a lot of fun. But it's not for everyone, really. Moving on, I think the next thing, when I started up, like I said, pre-day zero term sheet, day zero, one small office where I go lift the shutter up and go to office every day. There was nobody else. From there, I think one of the first things that I focused on, given that I was funded from day zero, I could manage to do that, is to put a team together. And I think I really went about wanting to create a team which is as best as I could possibly create. And probably everybody I could get on board was people who were better than me. It's not about getting a bunch of friends, or it's not about getting people who really agree with what you're trying to say. It's about getting complementary skill sets, people who can do things which you can't, and still being able to vibe with each member, and also being able to bring the team together into a cohesive unit. I enjoyed doing that, and I would think that was pretty intense during the first 2, 3, 4, 5 years. And I say that because post that it started to become a process. I personally didn't know everybody was getting onto the organization, but for the longest window of time, very, very closely involved in making sure that we get, and along that initial journey, Vish and I worked very, very closely, and that's something which we discussed almost every hire. I always over-communicated with the investor. So I'm sure Vish will have a perspective about how do you go about building an organization. I eventually exited when Loyalty Rewards crossed 500 people. And Vish has, very closely worked through that journey. So your perspective.
Yeah, I think the perspective also has a view on looking at relative to another 10 or 15 companies that we were associated with at that point of time, right? And I think the one thing that sort of stood out is I would always be in situations where, Bijai and I go for a meeting, and then he introduces me to a new team member, and the way he introduces and he glorifies them is sort of way above them, right? He doesn't introduce his team like, oh, this is my subordinate, or this is my equal, and he sort of ends up introducing people that are made to perceive like they're his boss, which also comes from a couple of things, right? One, there's a deep desire to want to build a team of people who can deliver. More importantly, it's also coming out of great amount of security of one's own self, saying that I don't need to appear to be this one numero uno alpha winner or the be all and end all. I just need positive outcomes to sort of build out and grow. And I think that sort of stood out. And one of the other things that played out well for the organization, and that was largely driven by Bijay's leadership, was that they never hesitated to sort of go out, hire the right guys, pay what it takes, and build an organization. We were not optimizing for, let's pay low, let's get somebody, let's make shift and get done going. We were optimizing for outcomes, and one of the best ways for him to optimize for outcome was to have a great team, and that really paid off over time, right? Because you get great people and they bring great people on, it sort of just grows into the organization. And I think to us as an investor, that sort of stood out, and even today when we talk to entrepreneurs, we say spend a lot of time for the first 5 guys that you're hiring, because they'll bring the next 25 guys for you.
Yeah, in fact, during those early days, I was probably willing to cut my right arm and give it to any guy who's going to add value to the organization. And that's really what I did for a long window of time, just identifying great people and almost hijacking them into coming into work with us. So that was fun. And moving on, investor value add. I think, this is an area where you can go first.
It cuts 2 ways, right? And I'll sort of talk about just an investor perspective, and I'd love to sort of request you to sort of step in and give the entrepreneur perspective, especially given in our case that you had 2 very different kinds of investors, 2 very, very different DNAs, right? I think, and it's been 12 years, a lot of humbling experiences. We made more mistakes than the good ones. So I think the big learning that I carry on my head is that, the entrepreneur is everything. It's great that we've had the benefit of hindsight, and it's great that I've had the benefit of 30 companies, but when I go and sit in a meeting with a founder or Bijai, they know really well on what they're doing. And our job is largely to ring fence them to make sure that they don't go do the most crazy things, because by and large within that range, they're supposed to be doing okay. Right? So in this organization, I think the one thing, and Bijay sort of spent a little time on it, was that we got used to very quickly a great amount of over communication, that we would have all the information that we sort of need.
And more.
Sometimes for good and sometimes for bad, but and more, yes. So largely, we'd have a sort of a monthly review meeting or a sort of a board meeting where we would sort of get in together, get a sense of the way the team was growing, the organization was going. But somewhere for us, and I don't know if that's a perfect solution, we as a DNA carried a very strong focus on cash flow and cash flow management. And hence, a lot of focus was spent around, hey, how much cash do you have in the company, and how is the business growing? Maybe it was a reflection that we were investing out of a small fund, so maybe we were fanatic about how much money is in the company and not. But those were sort of some of the things that we focused on the company. Particular to this case, this was a founder with a lot of domains, so we didn't have to break our head on business and networking. In other cases, we do spend time on early customers and early hires, but this was a very different situation for us. So a lot of focus just went on good governance, systems, process. How do you track cash flow better? How do you stay on top of metrics? Things like that.
Yeah, for me, probably because I started very, I had an investor right from day zero. I really looked at my investors as my partners, and I don't know how many entrepreneurs would say this, and this is not really a cool statement to make, but honestly, I had money from them on day zero, even before our first office or first team member or first client. So because of that, I really looked at my investors as my partners, and as a result, worked very closely with investors. So two advices that I had got from someone when I started up was, one is over-communicate. So I communicated like hell. So I would probably have multiple calls every week with all of them. So almost, I really used them as a team, as part of the team, getting advice, opening doors, clearing confusions. And the second thing that I learned, or the advice that I got, is never take a decision in a board meeting. It might sound counterintuitive, but what it meant is that all decisions are preferably taken in advance. All the discussions are done in advance, and board meetings are more procedural things that we complete, but there is no surprises that you pull in a board meeting. There is no real strategic decisions. In fact, I've done it once and that didn't go very well. Investors would need time to think through anything strategic. So our board meetings are very useful, and the learnings that I've had, one of my board members from Venture is a gentleman by the name Raghu, and between the board meetings when we go out and get a smoke, and the side conversations which I will have with Raghu is tremendous learning. So as an entrepreneur, I don't know again how many young entrepreneurs feel like this, but my board and my investors played a very key role in, and Indian startup ecosystem is also not that evolved. We're talking about 2008, 2009, and today awareness is significantly higher amongst the youngsters. During those days, it was really about taking one step at a time, and my board really contributed to the process of going through the early years. And off the board meeting, on the board meeting, very personal relationships. Didn't really have, we of course, like every other investor founder, we had our share of fights, particularly around cap table, but otherwise it was really a very strong personal relationship where we spent a lot of time together. I think Vish would probably feel as much of an ownership of building loyalty rewards as much as I did, because there would be no significant decision which is taken without your involvement.
I must say you're being kind. I think the glory is with the founders. We're just participants in the journey. But I think for the entrepreneurs in this room, there are two important messages that Bijay has given us, and it's this. I think oftentimes, and I'm an entrepreneur myself, I've taken money from other people, they're my shareholders, right? Sometimes you don't tend to share the problem, and you think that you have to find all the solutions. And in that chase, you end up under-communicating or you end up selectively communicating. One of the things I think that I learned from him was, good or bad, the news is out. Now, if there's a problem, we need to solve it. And we're not equally responsible, but we'll have to find it together. So there is no sense of I need to find a way to solve it with or without your knowledge. Those inhibitions, those issues are all out of the table. Then it's a very transparent setup. And the other board members also then over time understand that this is a very transparent setup. Then there are no knee-jerk reactions. Everybody takes everything, in a more calm manner and deals with issues at an issue level and not at a people level. And I think that's a great thing to solve for in a relationship between two shareholders, whether they're investor-promoter or investor-investor or promoter-promoter. Transparency, communication, simplicity is a good trait to carry. I think it just helps.
It totally worked for me.
And there are enough relationships that I carry where we're not able to get on a forum again together. And this is one of those special ones where I have the founder on relationship and we're on a forum together positively talking. It doesn't always happen. Both parties need to make it work and everybody needs to do their part for it to work.
Yeah, this is a very important, investor, entrepreneur, organizational vision fit. And I think it's an extremely critical point which we don't really look at that subject clinically and understand what it means. But, I'll let you go first, Vish, on, investment hypothesis, why loyalty rewards, and I'll share my perspective, and it's an important thought that I want to share.
So, for us, particularly, the hypothesis was sort of stemming out of two things. We were at a point of time, we were at a gifting company, and we're looking for additional avenues to push the gifts down. And loyalty was one great channel. But then we quickly, once we sort of got the initial meetings with Bijai, we also quickly understood that loyalty was just beyond gifts. I mean, there was a larger game around how do you get data on customers, how do you sort of build out a larger data science system to sort of rewarding customers, increasing sales on retail and on merchants. And as a seed fund, I think it was important for us to say that what is the quantum of risk that we were taking. While it's often difficult, and I'm speaking from a seed fund perspective, it's often very difficult to imagine how large, how much capital. I think the one metric we were trying to keep as investors was what is the level of disruption? Was it 1 to 5 or was it 1 to 5,000 or was it 1 to 5 lakhs? Because that then allows you to take the risk that you're taking so that the return then becomes very commensurate. And from an angel investor standpoint, it's sort of important for you to understand the stage you're getting in because largely it's an illiquid stock. It's largely zero except when you have an exit, right? What's important to understand is the quantum of innovation that plays out so that you're able to make sure that there's some alpha or some juice or some money for you to make in that journey. And different stage of investors have different math. A Series A investor will have a capital in to exit ratio. A seed investor has a level of disruption ratio. So it's important that when you're going in, you have some hypothesis to play out and then sort of keep revalidating and reinvesting in the hypothesis.
Yeah, on this point, this investor organizational vision fit, I think like all of us know, India has got a thriving startup ecosystem now, and there are startups coming out of every city and in tier 2 and tier 3 cities as well. But when you compare India with what's going on in China or in the US or in Israel, the startup ecosystem in India is still yet to take off in a significant way. We don't see many unicorns. There are a handful. Of course, we know the Flipkart, $19 billion exit, and there are a few companies that's got built. But given the hundreds and hundreds of startups, why don't we have hundreds of $100 million exits or $500 million exits? And one of the reasons that I think is this whole thing about an investor coming in at day 0 or day 1, Series A or pre-Series A, and the organizational journey. At least what I can share from my learning is, and I'm sharing this while Vish is sitting here, is that every investor has a role in an organization at a certain stage. I didn't know that when I was running my first venture. And Venture East, without Venture East's first check, I probably wouldn't have started up. But along the journey, somewhere around 5 years, 6 years, it was probably more right for me to give Venture East an exit and get some other bulge bracket investors and probably take loyalty rewards from a different level. When I exited, we had 1 billion consumer profiles under loyalty program management. 1 billion consumer profiles, processing 200 million transactions in a month. It's a scaled out business, but for you to scale a business from 100 million to a 500 million and a billion or a 10 billion, investor vision or the stomach that investor has, that's very different. And it's the entrepreneur's job to understand which investor is right at what time. If you don't get that right, you will not make that billion-dollar organization. So it's extremely, of course, you got to get many other things right before you get to that point. And once you get to that point, if you don't understand the fit well, you're not going to make a billion-dollar organization. And this is not to say that investor is bad or founder is bad. It's just about giving the first investor a great exit at a certain right time, and then getting the next kind of investors who can take the organization together with the founder to the next level. I didn't do that one very, very right. But retrospectively, I think that's one of the learnings that I would share, that to get investor aspiration, founder/organizational aspiration right is very important for you to scale out after a certain stage.
Yeah, I think if I were to sort of chime in, the organization DNA and requirements keep changing over a period of time. So you need to make sure your investor DNA by majority matches with your DNA, or your DNA matches with your investor DNA. I think in our case, it was more the latter that that sort of phased out, but that's something that needs to be sort of kept in mind.
Yeah, I think we took this earlier as well. The life of an entrepreneur is not easy. There are days which are unbelievable highs, and there are days when you don't think you will cross. Personally, for me, when I look back, I can think of various junctures of the organizational evolution where I didn't know that we'll cross that month, whether we'll survive that month. There was unbelievable lows, and that's also why, like I said in the beginning, it's a great idea to go and start up when you are doing very, very well otherwise in your corporate career. When you're flying high, doing extremely well, not when things are not going well, this is not working, so let me go start up. And the reason why I say that is, for me, when there are windows of time when things are so tough and so low that I had to constantly think back at my corporate career and say, hey, I've been there, I've done some interesting things, I'm going to cross this. I need to go back to the better windows of time to draw energy to cross the lows that I've had. And no organization, and we know the stories about the ones which have got built in India, whether it is, again, Flipkart or Paytm or any one of the startups which went on to become large organizations. Some of you may know, some of you may not, but all of them have had many near-death experiences before they've reached where they've reached. And as a founder, when you're going through that near-death experience, when you really don't know whether you're going to cross the next, and you're fighting with your investors, you're fighting with your board, you have team challenges, and you've got client challenges, you've got tech challenges, and you can really think that it's just going to crumble. And it's just your internal energy to push through that window and go to the next window. It's really tough. And again, that's also why it's not for everyone. The highs are easy to manage, the lows are not very easy to manage. Well, cash is the blood of business, and the one line that I can only think of is early warning systems. Vish and I were joking about it this morning. The multiple times then, as an organization, we've ran into a pocket where we ran out of cash, and then fundraise is always a 6 months job. So cash management, that's something which, like Vish said, I learned from Venture East as well. Cash management and cash flow management is extremely important. But Vish.
Yeah, I think one thing specific to us, and one thing more generic for you guys to take away is, it's always good to let investors know and let the shareholders know when we need to raise money and what outcomes we're working towards. It's a given that not all 100% of the plan will work. Only some of it will work. Hopefully a large piece of it will work. But what's important is that you're on top of your cash flow. You're on top of when you'll run out of money, or you're on top of when you'll sustain. Because this whole investment, shareholder values is heavily centered around how much you're raising, when you're raising, what you're doing with it. So, and of course, Bijai threw this word, early warning signals. And this sort of goes back to your own, as a founder, ability to track what's going on in your business. Where are levers of losing money? Where are levers of making money? Where is money being lost? And how much money do you still have left? Being on top of your cash flow is superbly important. In fact, I was very surprised. I was talking to a friend of mine in Israel, and they shut down companies if they don't have cash flow for 2 months. They're extremely finicky about closing costs and stuff like that. I mean, of course, that's one extreme example. I'm not a believer of that in India. I think we should sort of try and pull and survive and build out as long as we can. At least that's my DNA. But the point here is to make sure that the founder is on top of, the bloodline, which is how much cash do I have left, how much oxygen do I have left, and sort of play it early with the board and investors. You're running out of money, let's go work on it together sooner than later. Don't throw surprises, because people are not built to deal. I mean, investors, especially my kind, we're not great to deal with surprises. I mean, if you keep telling us things are going bad, it's easier than putting one fine day a big surprise on us.
Yeah, this is not an area which I did very well. And I think, again, multiple times that running out of cash. But the good thing for us was that the business was doing well. The business was scaling really, really fast. And so investors really stepped in. We had our stress situations, but we crossed those windows. I'm going to breeze through the slide, but the only input here is there is a lot of Greek and Latin here for young entrepreneurs. Investors, of course, well versed with these terms, whether, put option, call option, earn-outs, or anti-dilution, liquidation preference. The reason why I put this slide is for young entrepreneurs, it's extremely important for you to understand the essence of these terms. What does it mean? Sometimes it looks like boring stuff and you want to just go build the organization, build the business and do well. But as a founder, if you don't understand these terms well, and you're going to sign some agreement or the other with the investor, if you skip some of those things without understanding what it means, it will come back to bite you. So it's important for you to, whether it look like Greek or Latin, it's important for you to understand the essence of, if you say assignability, it's not just about assigning rights, but if you do, what impact it has in next round or 2 rounds from now. The sense of understanding is very, very important. And there's no easy way to learn it, but just go through that and read up and understand.
And hire a good lawyer.
Yes.
I think this is our last slide.
Last slide, yeah. So we ran out of time, but very quickly, as an entrepreneur, again, when I started up, I didn't even know the word exit existed. But one advice that I can give to young entrepreneurs is that it's your responsibility to think through how you're going to give your investor an exit. And to talk about an exit, talk about the company possibly getting acquired is not a bad thing. When I started up, I felt that I'm starting up, how can I ever talk about selling? It might look like I want to make some money, and that's not the kind of sense I want to bring to the table. But fast forward today, what I would tell young entrepreneurs is that you need to really think through how you're going to give money back to the guys who are going to give you money to run the business. And that's called exit. It's not so bad a word.
Yeah, I think there are 2 parts here. I'm sort of going to pick back a statement that Bijai made earlier. I think the entrepreneur needs to step back and understand that they have a long journey. Of course, they decide how long this journey is. But the journey of the investor does not have to be on the same journey. The journey of the investor may have a stop sooner than their own endpoint. So it's important for the founder to think, and the good and bad part of taking somebody's money is you have to give it back. So now that you've raised money from somebody, you have to find a path along the life that you exit engineer this investor group or this person. And you might also want to reflect upon whether you want to build a very large institution that sort of IPOs and self-sustains, or you sort of want to transition this company to a strategic outcome and come back to doing something else. While this may not be something for you to think of on day 0 or day 100, I think as you sort of onboard different investors, especially different funds of different vintages and different DNAs, it's very important that you start thinking through when each one's journey or each one's retirement time comes, and sort of make sure that your organization cycle is unaffected by some of these retirements that sort of will keep happening in its course. So think of founder exit along its life, but more important, think of investor exits in a more periodic and cyclical fashion.
But this is not something which comes to entrepreneurs naturally, because they stay focused on building the business, getting clients, delivering business, cash flow, profitability. The exit is not something which comes to you naturally, but as entrepreneurs mature and the ecosystem mature, it's important for the entrepreneurs to think through and have a perspective on this.
Absolutely.
Yeah, I think that's it with all of that. Like I said in the beginning, extremely happy to come here and share the journey. We've had a wonderful experience now. Both Vish and I are running 2 separate organizations. Vish as an investor, I'm back to being an entrepreneur again and doing the second venture. But very happy to have had that 10-year journey. not an opportunity that a lot of people get. We consider ourselves privileged to have that opportunity, and happy to have come and share the knowledge and experience, and can't contain all of that into 30 minutes, but happy to share in any other way. It's good to see the ecosystem, thriving ecosystem in Cochin. Thank you so much. If there are any questions, we can take it or we can do lunch.
Thank you guys. Very rare do I get a chance where someone we've invested in has made money for us and is still talking good about us. So it's nice to be here.
Thank you very much. Any quick questions? We'll take maximum 2. Thank you. Thank you very much. Thank you very much, sis. Thank you very much, all of you, for being patient audience. I'm sure all of you are hungry by